Stocks, bonds, ETFs, straight out of downtown Chicago. This is Zacks Market Edge.
Welcome to Zacks Market Edge, the podcast about investing in your life. I'm your host, Tracey Ryniec, and I'm joined this week by Zacks senior strategist Kevin Cook. He's also the editor of The Tactical Trader and the Follow the Money Trader, two investment services here at Zacks. And this is actually part two of a podcast we've done this week about what's happening in the stock market right now in this month of January 2016 and how you can survive and thrive, I guess is the word. And on this segment, we're going to talk about the technicals about what's happening, where the S&P 500 is. I kind of like the small caps. I've been watching those. That's not actually flashing a good indicator right now. And Kevin's going to give his viewpoints and viewpoints of a couple of big name investment managers and what they're thinking right now. Because Kevin, it sounds like, people are kind of bearish.
Yeah, obviously the crowd is bearish.
Right.
And last week, we came into the market. I was prepared to be a buyer for Tactical Trader just because I was looking for a capitulation low. And that's exactly what we got on Wednesday. I have some technical indicators I look at that tell me when the selling has reached a climax and you want to step in and be a buyer. And it worked out perfectly. There was also, many sentiment indicators that were overly bearish, whether it's individual investors or fund managers.
Now, do you consider that to be a short-term capitulation?
Well,
or was that the bottom?
That's hard to say, so here's my caveat and my concern. I listen to big strategists and economists, and a couple of big strategists that I listen to are actually very subdued right now. One is Scott Minerd from Guggenheim. They manage $240 billion, and he oversees that. He last week was at Davos in Switzerland, and didn't come away very excited about anything. And he started making calls that, hey, I see the market having another 10% downside, could go to 1650 on the S&P. So that concerns me when a guy like that says...
Is he normally bullish?
Yes.
What is his normal?
Yes,
okay.
He's normally very even-keeled.
Okay.
This is a guy who's also an expert in the credit markets. Before he became the chief at Guggenheim, he was a bond fund manager in Europe, knows the credit markets well. He writes a weekly thing on high yield. So he's a very even-keeled investor, very responsible, I see him as. So, for him to make this shift, and, he's not a trader, he's not a perma-bear. The other guy I saw this morning was Jim Paulson of Wells Fargo, not being very optimistic about the lows holding, looking for the market to definitely test 1,800 and go lower. So we can't say for sure. One thing I want to bring up on the technical side is, you know as well as I do that money was hiding out in big cap and popular stocks.
Right, exactly.
In
We're all in
December.
Home Depot.
Yeah, and in December, the glamour stocks, FANG and that sort of thing.
Yeah.
In December. One index that kind of told you things were rolling over was if you looked at the S&P 500 on an equal weight basis. On stockcharts.com, the symbol is SPXEW. That index went down and touched its February lows last Wednesday. So whereas the regular S&P 500 went down to 1820, which were the October of 2014 lows,
Right.
the equal weight index was racing lower ahead of it.
So what that indicates is that, just for people out there who might not understand what you're talking about, that means if everyone's racing into, say, a Home Depot or a McDonald's, the weight of those gets larger compared to everyone else, and then it makes it seem like things are better versus if you actually say, oh, that's equal to something, Exxon or...
Yeah, what the equal weight index does is it just takes all 500 stocks and gives them the same proportion in the index. In that way, the index is not being ruled by the mega caps like Apple and Google and Home Depot and others.
This used to happen with the triple Qs back in the day during the dot-com boom because it was so heavily weighted in, the Microsofts and Cisco, and there was something like 10 of the stocks were the top 50% weighting or something crazy, and it skewed it.
Right. Yeah. So
that's
why it's always good to look at the equal weight index to see what is the, this is a simple breadth indicator. You hear technical chartists all the time talk about what market breadth is doing, and they can show you 20 different charts of market breadth. here's the simplest one you can look at. Look at the S&P on an equal weight basis, and it tells you,
But this would seem negative.
yeah, well, right now it is. But the thing is it went down and tested those February 2014 lows and bounced. Now, the question is will the full cap-weighted index go down and test those February 2014 lows? And you know where those are? S&P 1740.
Okay.
S&P 1740 is where the index went in February 2014. That's also an area I'm looking at on a valuation basis. We talk about the valuation reset. When does the market become attractive again?
Right.
Well, if the S&P is going to earn $120 this year, and that's actually below consensus. I followed David Kostin of Goldman Sachs last year, who was already at $120 for the S&P when everybody was still saying, oh, no, we're going to make $126. Yeah. Now they all come into the new year with energy imploding. They're bringing down their estimates. He's at $117 for the S&P. So you start to get down to 120. Well, at S&P 1740, 1750, the S&P is trading at 14 and a half times on a forward basis. Now, that's a little more attractive, right?
That is more attractive.
Than 16 times.
Definitely.
Yeah, so I'm definitely a bigger buyer at S&P 1750, but we're long right now and looking to play this bounce however it unfolds.
Right. Now, what about the small caps? I follow the small caps as kind of an indicator of risk because obviously if you're scared, you get out of those right away. And they've been so much weaker than the S&P 500 or the Dow or anything else.
Yeah, they were the first to just get thrown out.
They were down at one point, almost 15%, I think, year to date.
I was looking for a rally into the new year, and we pitched our small cap positions in late December just because things didn't look right. That Santa rally was too feeble. So here you have the small caps, which should be benefiting from a stronger dollar and cheaper oil, right?
And they're domestic.
Yeah, stay domestic.
Yeah.
Don't have the dollar
They're like
risk.
The small restaurants and all that.
The consumer's doing great. You had all these things that you would think were tailwinds for the small caps, but they're just getting obliterated. And part of that is I think you've got a lot of small biotechs in there. You've got a lot of small banks who aren't getting the lift from a steepening yield curve.
Right. That's not happening.
And you've got a lot of small energy too. So that's really what's going on with the Russell. And let's be honest, the whole market capitalization of the Russell 2000 is equal to less than 5 companies in the S&P.
Right.
So
right, that's true.
So let's just keep that in perspective. And I think you just have to be selective. Yeah, be a small cap stock picker. If you can maintain that risk. And if we see this index back up and go again, I haven't even looked. I'm just gonna type in RUT here on my charts and see how poorly it's doing. I mean, I can't even find how far back do I have to find this?
You have to go back pretty far back.
3 years or 4 years? Let's take a look here.
It's pretty far because I tried to find it too.
Okay, yeah. So we're back into early to mid 2013 lows.
What's that level?
So we're back up to 1,000 on the Russell 2000 index, which was where it found support in August of 2013. But we dipped as low as 950, which is where it was in the spring and early summer of 2013. So there probably are a lot of values in the small cap index, and if the index itself finds support here, I think that is encouraging, and it backs up the thesis that hey, domestic is going to be okay, and those sectors are going to be okay. The strong dollar isn't going to hurt them, and the consumer is still there.
Now, what about? I know you've been writing about some of these very bearish technicians. They're not the big money manager; they're just the technicians. But I don't think we can ignore them altogether. I know you brought up one who was using the Fibonacci, method or whatever that is, and she was super bearish, right? What do I, as an investor, do I listen to any of this, or do I just try to ignore it? And the same thing on the bull side, although I haven't heard many of them lately.
Yeah. I think you still have to, your market framework still has to include fundamentals. You cannot be purely technical. So if we just look at the economy and the fundamentals, we have to align with the fact that bear markets rarely occur outside of recessions, right? So it's a very extremely rare occurrence that you go into a 25, 30% bear market decline in the stock market without a coincident recession in the economy. Are we Do we have any data that says we're going to recession? No, just the manufacturing weakness that we talked about. So I think that's the first thing you need to address and get comfortable with the data there and be looking at that. Now, but the technicians will still say, "Oh my gosh, yeah." I mean, that Fibonacci person, she had projections of the market could go down, to S&P 1300 or whatever.
It was really, really low.
But those are just projections of what the market could do based on that Fibonacci math. It has nothing to do with the real market and what's actually taking place. So what I think is, could the market go to S&P 1650 like Scott Minerd says of Guggenheim? Sure, it could.
Sure.
If it goes below 1600, I'm wondering if we're already in recession.
Right.
If that happens, then I'm really looking at all the data and starting to wonder. But we're still producing 200,000 new jobs a month.
Yeah, the job market. But that is a trailing indicator always.
Yeah.
But so far, the weekly jobless claims haven't been indicating.
Just ticking up a little bit.
A little, but that will be a result of energy. A lot of jobs are being lost there. It's not going to be real good in certain states, but the rest of the country should be okay.
Mm-hmm. And the other technical thing here, when you start to get down and talking about 1600, is a lot of people would love to see a retest of the bull market breakout. That 1575 area, the highs in 2000 and the highs again in 2007. Does the market need to come all the way back there after this huge run? Everybody talks about, the market's up 200%. I don't even care about that I look at it like, hey, we had a big correction in 2011. So I say that, that's where I'm starting from. I'm starting from S&P 1100. And are we going to go all the way back there? No way.
Okay.
So we get down below 1700. I'm a much bigger buyer as long as the economy's fine, because I think the valuations will be terrific.
Yeah, I've been watching to see what the insiders are going to do. They're on lockdown right now because they can't buy ahead of their earnings reports. But as more of these earnings come in, the window opens for them usually. And their shares, most of them have been hit hard. And historically, if there's no recession or something else bad going on at these companies that they don't like, they will buy because they see deals in their shares. They think the selling is overdone. So I'm waiting. This quarter is going to be key. I'm waiting to see if they're going to jump in mass. So, they did in 2011.
So you won't start to see those until after a couple more weeks of earnings here?
Yeah.
We got to get through the bulk of earnings and then they'll start to show up.
Exactly. Because usually they report, it depends on the company, but they'll open the window a couple of days after usually. And then it's a couple of days after that when the forms are filed and we get access to them. So it's a little delayed.
One thing I'm looking forward to, we know the manufacturing data has been weak, but the number one currency of bull markets is confidence. And so what I'm looking forward to is Tuesday. I call it Confidence Tuesday because we get two big surveys. We get consumer confidence and we get the State Street Investor Confidence Survey. And both of those have been strong. I want to see what they look like after this correction.
The consumer,
how much they pulled back.
The consumer so far seems to be holding up. Like they were real confident even at the beginning of this month, coming out of the holiday season. I definitely will be looking at that. Now, why do you like the State Street one? We should tell the listeners why you like that one.
So I mean, this is a survey that State Street does, and it's based on actual allocations. It's not just how are you feeling about the economy. It's how are you positioned? They're asking.
And these are the professional managers.
Yeah, they're asking institutional investors, how are you positioned? Are you up to 5% cash or more, or have you been buying into this? So that's been very strong for the U.S. It's been ticking up for Europe, and so I'll be very curious to see. And you could find both of these. Just go to the Bloomberg.com economic calendar, and you'll see both of them on Tuesday, and you'll see the results.
Okay.
And you'll get a graph of where it's come from, where it's been.
Okay, I'll definitely be looking out for that. As far as how to play this, I know I like I was saying, I like the small caps, and I am buying on even this weakness. We might get weaker still, as we were just talking about, but I kind of have been dollar cost averaging into my position, the old-fashioned way of doing it. And I do like a couple of the ETFs if you want to get into the small caps, because I think that's a better way to play the small caps. Obviously, there's the overall small cap ETF for the Russell 2000, which is the ticker IWM. That's just the general one. But I do like some of the specific ones. I like the small cap growth sector, and Vanguard has a real cheap, easy ETF you can use with the ticker VBK. And then there's the flip side, the value side. Value's been underperforming growth for several years now, but historically, the small cap value has been the best performing. So I still like that area. I actually own this one, and that's the ticker VBR, also by Vanguard. I don't know if there's an area you're liking right now in terms of ETFs.
Well, I promised you that I'd give you
I want to know
an
this.
ETF where you can have some biotech exposure, but it's also the blue chip biotechs along with big pharma.
Exactly. I didn't know this one.
This is the Power Shares Dynamic Pharma ETF, PJP. I own it for one of my services. PJP is the symbol, and it owns the blue chip biotechs. Gilead, Amgen, Celgene, Biogen, and then it owns the blue chip big pharma, Bristol Myers, Merck, Pfizer. So you're getting, and I think that a lot of those have become better values now, and they all have long-term stories. So instead of trying to pick, which horse is going to win, like, do I just buy Gilead
it's so
or do
hard
I just
in
buy
the drug
Pfizer?
area.
Just buy the basket of what's called dynamic pharma and see how it goes. And for technology, I like Avago. I own that for FTM Trader, Avago Technologies. I also, in my Zacks Confidential last week, I recommended for more conservative investors who also didn't want to pick a tech stock, just buy the QQQs between 95 and 98. I recommended that on Tuesday, and the next day you got the dip below $98 on the triple Qs. I think they're up. Where are they now? Trading above. Are they above 102 here?
They're a little higher.
Yeah, they're above. Yeah, they're almost to 104 today. So that's a good place if you don't want to pick a stock in technology.
Right.
Just buy the triple Qs right now. We're going into earnings season. I think it's going to be good for these companies, and so you definitely want to be a buyer down there.
Okay, that's some good advice. Thank you, Kevin, for joining us on both Podcast 1 and Podcast 2 with a lot of good, interesting details about what's going on out there. I know it's been a rough couple weeks for investors, but it's always good to have information. And obviously, you can always check out any of our other podcasts on iTunes or on SoundCloud.com. You can also get podcast number 1 from this exchange on there. And you can follow Kevin's other advice and read what else he's writing about on Zacks.com. My articles are also on there. And you can check out some of his trading services on there, the Tactical Trader and his Follow the Money Trader, also on Zacks.com. So until next time, we're going to have you on again. Don't forget, when the big institutional guys have to report what they own.
Right.
That's always a hot topic. So we'll have Kevin on again about that.
In mid-February, they'll have to issue their 13F holdings.
Yeah, so make sure you tune in mid-February 2016 for that, because that's always really interesting to see where the big money managers are putting their money. So for Tracey, this was Zacks Market Edge for this time, and I'll see you next week.